This is InvestTalk, independent thinking, shared success.
Hey, InvestTalk guys. I was hoping you guys could take a look at Supermicro Computer, ticker's SMCI, and let me know what you think about it. It just pulled back. Is this a buying opportunity? Things in the news about potential fraud over. Is that something that's still a headwind for the company? I know that came out the past few months or the past year. It's got me hesitant, but I feel like a lot of the analysts talk about all this growth and it could potentially be undervalued, and this might be a good opportunity to buy. So I'll listen on the show. Thanks, guys. Bye.
All right, looking at Supermicro Computer, and you make a fantastic point, and it's a reason I would avoid it, is because when there's smoke, there's fire. There are some recent accounting issues and a lot of worries about fraud there. And, there's a lot of short interest here, and that can create big rallies, but there's a reason why there's so much short interest, right? Because once again, when there's smoke, there's fire. That's what history says. And now Supermicro, they make application optimized server systems, mainly for AI development. And so not only do you have the risk of AI in infrastructure investment slowing, I don't think it's going to go away, but it's most likely going to slow due to the lack of killer applications being developed, the slower progression of AI capabilities, which was kind of shown recently with the rollout of ChatGPT 5. And so, you have those double risks there. Are they really selling as much? Do they really have the right margins? And even if you look at what they're posting recently, earnings last quarter were down 24% year over year. And the previous quarter before that, they were down 53% year over year. So full year 2025 earnings are expected to actually decline 3%. So where's the beef here? Where is this killer application, killer products that they are producing? They really aren't. They're not producing anything special compared to a lot of the other server makers that are out there. Okay, so I don't see an economic moat. I see a lot of potential risk around the accounting issues, and then obviously a slowdown in AI investment. So I wouldn't buy into the hype, and the technicals, frankly, are looking pretty poor as well. So I'm passing on it. Thanks for the call. Now, every day we receive questions from the comment section of the InvestTalk YouTube channel. And here comes one that came in earlier. SSJ Baller says, "Hi, Justin. What are your thoughts on silver now? Is it time to take profits or hold longer?" Looking at EXK. EXK is the symbol. And this is Endeavor Silver. And it's a smaller name, $1.5 billion market cap. They are supposed to lose money this year, but make 48 cents next year, which would be a huge all-time highs in earnings. Trading at $5.75. Now, will they make that? Probably not, but that's what analysts currently project. Now, the broader question is, how much silver exposure do you want to have? Now, I do think silver will continue to go up. We're in the midst of monetary debasement, and that's kind of the only way out here with our debt situation is monetary debasement. A weaker dollar will certainly help gold as well as silver. And when you're in a precious metal bull market, historically, silver does outperform. But we're also in this environment where central banks around the world are buying a ton more gold. Are they buying a lot more silver? No, not really. So we continue to lead on gold. I think it's okay to have some silver exposure, but if you're betting on precious metals in general to guard against monetary debasement that is likely ahead, I don't think silver is where you want to lean. Let's get it. Can you have exposure? Sure. I think you still want to lean gold. So if you have no silver exposure and you have substantial gold exposure, whether that's through miners or GLD or some other gold proxy, that's good. And adding this is fine, but probably wouldn't be my favorite silver name. And once again, it wouldn't be where the majority of my precious metal exposure would be. Thanks for the question. I love those YouTube questions. Now, what are we going to pivoting to? Oh, we're going to a live call right now. Don in Orinda, California.
Yes.
Looking at UPS.
I'm curious. That's exactly right. 1 year and a few days ago, I purchased UPS, understanding it was going to come under a little bit of pressure.
Mm-hmm.
I'm now down 30%. Should I just go ahead and dump it, or is it still?
Well, it depends on your time horizon. It depends on your time horizon. The technicals on UPS continue to struggle. Obviously, there is there's the tariff issue that's going to probably reduce the supply, the flow of goods throughout our economy, and UPS is in the crosshairs of that. So, and the technicals continue to kind of weigh on the picture in the shorter term. Now, at some point, this is going to bottom out. We're still going to see products move. It's still a good business with a good balance sheet, with good profitability. So am I hopeful that this turns around in the next week or month or by year end? I don't get jazzed up in that risk proposition. Now, do I get excited about buying it here if I have a 5-year time horizon? Yeah, I think this is a good valuation to make that bet, right? Price to sales now is down around 0.83, which I don't think it's ever been this low. Outside of the financial crisis, 2008, that's the last time UPS on a price to sales ratio basis has been this low. So from that perspective, I would hold it. So it just depends on your time horizon. Thanks for the call.
Hey, Justin and Luke. This is Josh in North Carolina. I had a question. I'm going back through Steve's book on investing, and around page 13, he talks about the VIX. And I track the VIX along with my other stocks, and he was talking about how the VIX can be used to signal might be time to purchase or sell a stock. I'm a little confused on that. Could you guys go back over that at some point on your show and just discuss the purpose of the VIX and maybe a few examples of what those numbers might trigger? I know they're relative values, but been listening to some other podcasts, hearing one or two folks mention the VIX these days just as a signal that the market may be getting ready to change, maybe getting ready to slow down or something, not sure. But if you would, enjoyed reading about it in Steve's book, but just need a little bit more clarification on how to use the VIX. Thanks a lot.
Great question. And certainly there needs more context after, since Steve wrote that book. Steve wrote that book a long time ago. But the institution of volatility, vol selling funds, shall we say, has kind of changed the dynamics of the VIX a little bit. But I'll dig into that after I give you the broad overview. The volatility index is simply a put-call ratio, how many puts versus calls are being traded. And when it's elevated, it means that a lot of puts are being bought on the market. And that means there's a lot of fear. There's a lot of people trying to buy protection. And usually when that happens, well, the market is set to bottom, right? It means that when you get a spike in the VIX, there's a lot of fear and, you buy fear, right? You typically sell greed. And so that's what the VIX index is helping with, is where are we in the fear and greed type of spectrum. And that's why when the VIX elevated, 30 plus, that's usually a time to really, really buy in and add, take out some cash from your portfolio and buy some positions, especially those that have been on your watch list. Now, with the volatility funds, there's a lot of people going out there selling zero DTE, day sell expiration options, and really trying to bring in income into their portfolios and their strategies. And there's a lot of now ETFs that are running those type of strategies. You saw this blow up a few years back. I'm trying to remember when it was. I think it was pre-COVID, when you had volatility just explode, and a lot of these went to nothing. So what you see now is that every dip is even not only just being bought by the average investor, but that volatility is being sold, and that actually suppresses volatility over time. And it's actually kind of skewed the signal of the VIX because it's becoming more suppressed than it probably should be because of those vol selling funds. That's why you see the VIX now hanging around. Let's see where we're at now with the VIX. hanging around the mid-teens. Usually the low 20s was where it was trading at many years ago before these vol selling funds. And now we're once again hanging in the mid-teens. So it's really about when does it spike, and that's really the best signal, right? The recent spike in April went up to about 60, right? And so a signal that you want to be buying a bit into the market. So that's the way you want to use it. Thanks for the call. Let's go with another YouTube comment question. And Spen says, what are your thoughts on Celsius, CELH? I've been holding it for around 4 months, and I'm about 60%. Do you think I should hold it long term, or should I be looking to sell? Now, this is a name I kind of liked a few months back, and I actually bought it for my personal account. We didn't buy it for clients because it was a bit too speculative, but I did buy it in the 20s or 30s. And frankly, I sold it in the 40s, so a little early. But now it's at 60. Now it's starting at $1.10 this year and $1.45.49 next year. So one of the reasons I sold it was just got a bit elevated in price, and I think you missed it. I think at 60, it's not cheap. I think in the 20s, it was cheap because it still had that growth potential, good balance sheet, and I think they thought it was going to snap back in earnings. And that's what's happened, right? Last year, 2024, earnings fell 9%. And so that's why the stock fell from a high around $100 per share to a low around 21. And that's natural. You have company trading at very high multiple and growth goes negative. Well, that multiple is going to disappear. And it did. But now you're seeing a bit of growth. And I don't think you're going to, this growth profile is all over the place. And so now it probably doesn't grow 57% earnings this year, another 35% next year. That's probably the pendulum swaying the other direction. So I would keep an eye on it. I think at some point valuations get attractive again, probably sub 40, but not at $60 per share. Thanks for the call. Now let's talk about stagflation. And what does that mean for global markets? Now, this is according to Bank of America Global Research. This is in early August, early this month. They said 70% of global investors surveyed expect stagflation over the next 12 months. So you're talking about below trend growth and above trend inflation. That's stagflation. And you've seen that as of late. You've seen labor market weakening. You've seen inflation measures starting to perk up again. I said that in the back half of the year, you're likely to see that, and you're starting to get that, right? You saw the PC's Friday, the PPI, Producer Price Index, starting to reaccelerate. It typically leads CPI, that typically leads PCE indicators, okay? So if the labor market continues to flounder and you have a rougher economic picture, from a growth perspective, you're getting stagflation, and those signs continue to creep in. But how does that manifest in markets if you solidify stagflation? Well, the first is longer dated assets tend to go down. Think of longer dated bonds. Okay. Why? Because they erode the value of fixed interest payments over time. Or think of going back to 2019. 2019, interest rates were low and inflation was low. And then you saw a huge price increases. Well, that eroded the value of those coupon payments multiple years out, because the assumption was that the value of that dollar that you would get many years in the future would be roughly the same, right? There's a little bit of inflation, but not a big deal. But if you start to see stagflation, you're getting a lower dollar, most likely, because of the impact of the economy. So when the economy of the domestic market weakens compared to the rest of the world, that currency will weaken. And that's what you're seeing recently with the dollar declining. And so many investors, not just average individuals, but also pension funds, insurers, they invest in longer dated bonds as well. And they are certainly worried. They're pulling back from their exposure to those longer dated securities. And if you see a sell-off in 10-year, 30-year, et cetera, then you're going to see impacts across other asset classes that are longer duration. Think of growth stocks, for example. This is what happened in 2022 when interest rates rose dramatically. You have the NASDAQ down 33%. And a lot of the Ponzi type of names fell out of bed, the Pelotons of the world, et cetera, that just didn't have business models that were sustainable. Okay, so that's how it can manifest into the rest of the equity markets. And then you have other assets like gold. Gold will continue to be a tailwind to gold prices like it was in the 70s. And it already is an asset class that is go-to right now because of the geopolitical volatility that we're seeing and the fact that central banks around the world continue to buy it. And so gold will certainly get a continued tailwind. Other assets that might be good, think of short duration inflation-linked securities. So think of short duration tips, 0 to 5 years. There's an ETF out there, STIP, kind of similar to that type of exposure. So that's the way stagflation, if it gets entrenched, will impact the markets overall. Let's go talk to Richard in Valencia looking at MAA and INVH, Invitation Homes.
Yeah. Hi, Justin. Thanks for taking my call. Looking at investing in a REIT, investing in real estate, and two possibilities. The apartment side, the MAA, the Mid-American Apartments, versus residential houses, the Invitation Homes. Given this economic environment, what do you think would be a better place to invest in?
I think it's pretty clear. It would be apartments. Because if you have a situation right now where prices across the board, and for the most part around the country, prices are elevated. The affordability indicators are very poor. And I think we're going to go through a 3, probably 5 year period where broadly housing prices are going to decline a little. Now, it's not going to be '08 where prices decline, 30, 40%, 50%, depending on the market, obviously, in a short period of time. I think it's going to be, single digit price declines in most markets for the next 3 to 5 years to correct this overvaluation in real estate more broadly. And I think there's going to be continued low activity within the real estate market because I think mortgage rates are going to stay relatively elevated. Can they come down? Could you see the 5 handle on mortgage rates right now? Mortgage rates are at 6.8% roughly. But could you see a 5? Sure. And that would help the housing market a little bit. But it's not going to change really the affordability crisis that we see throughout the country. That means more and more people are going to be forced to continue to rent because they can't afford to buy a home. And that's going to help the apartment sector. Now, we've done deep research on the apartment REITs out there. I will say Mid-America is not bad, but it's not the best in the REIT space when it comes to apartments. So I like what you're thinking, but I would definitely lean on the apartment communities more than the REITs that own single-family residences.
If you're looking at having a little bit of diversification, we're not saying though don't do any in like an Invitation Homes, but I think what I hear you saying, you'd put a lot more in the apartment than you would the houses.
Yes, but probably before I even go to housing REITs, I would diversify into other types of REITs out there. Right? There's a dozen or so different types of REITs that you can invest in. Yeah. I would probably rather own, and I usually don't say this, I rather own a mortgage REIT than a housing REIT. Okay. You get better yield. You're getting exposure to housing, but you're getting it at a a better with better collateral, right? You're kind of getting the backing of the underlying, because I think there's still a lot of equity in these homes, but you're going to feel it. And you see that with Invitation Homes, relative strength is pretty bad, right? And so I would not be getting exposure to, they'd be low on the list. If I'm talking about, the dozen or so type of REITs out there, a housing REIT would be very low on that list.
Yeah.
Right?
Right.
Thanks for the call.
Thanks a lot.
No problem. Let's pivot back to the InvestTalk voice bank for this question that came in earlier on 888-99 chart.
Hi, Justin and Luke. My name is Jim from New York. I have a general question about retirement accounts. I am currently a full-time employee, and I have a 403B. I also have a small business. I'm self-employed as well. I was wondering if I can max out my 403B for my full-time employment and also start another retirement account for my small business. Can I contribute to two different retirement accounts, like a SEP IRA or another kind of a retirement account for my small business? Is that possible? Is it legal? Thank you.
The simple answer is yes, you can. Now, there are limitations to it. There's limitations basically in income and total contributions. So this is something that you want to talk to a tax advisor, whether it's a CPA or some other licensed tax advisor, to help you with that, because obviously I don't know your income. But you can contribute to a 403B or a 401k or a TSP and contribute to an IRA or Roth IRA or SEP IRA, depending on what you qualify for. But it depends on your total income and that total contribution. So make sure you talk to a licensed professional before you do that, okay? Or an advisor, a financial advisor like me, that would go over exactly what this looks like and help explain kind of where you're at within the rules of the tax code. Not a tax professional, but the basics. But once again, you have to know kind of intimately what that income really looks like. Thanks for the call. Great question. A lot of people don't know that. A lot of people don't understand that it's not just your 401k. It's not just your 403b. It's not just even an IRA, right? You have limitations to that, the capped contributions, but it's always good to consult with a tax professional before you make that contribution. Now let's talk a little bit about the labor market, something that the head of the Fed, Jerome Powell, talked about on Friday at Jackson Hole. And what he said was the labor market environment is curious. That was his quote, curious. And it's really a lot about shrunken supply of workers because of immigration restrictions. And that's the hiring side. That's the supply of labor side. But then there's the demand in labor that is also drying up as well. And it's an interesting case because there's not a lot of firings, very little. Okay. But the pace of hirings has slowed dramatically. In June, the hiring rate, number of hires as a share of the overall U.S. population, was just 3.3%. In February 2020, pre-pandemic, it was 3.9%. And it was 4.6% as we were recovering from COVID in November of 2021. So 3.3 is very low. And there's a quote from the Dallas Fed monthly manufacturing survey. This was in July. And one executive said, quote, "Tariff changes require a sit back and watch attitude. There is no way to forecast," end quote. So it's the lack of clarity about the future economic environment, as well as the low labor supply, that is really the culprit. Now, there's the other aspect that is probably less discussed, and that's that employers, they overhired during the pandemic. So a lot of them have a lot of excess labor to throw on any demand, and it just doesn't make sense for them with that lack of clarity to continue to hire more. But they're also not laying off workers because overall, you're still seeing earnings growth for companies, even though it's slowing, across the economy. Now, layoffs as a share of total employment came at 1% in June. That's not much higher than the 0.9% reached during 2021 when, the economy was roaring back, right? So people aren't getting laid off. They're just also not getting hired. And this is really hurting the younger people who are, right, graduating from college and looking for a job. And then those on the lower end of the spectrum, poorer workers, they're also starting to see their wage growth cooling. Because those owners, right, they're going to, I don't say punish, but they're going to pay less attention to those lower income workers than those higher paid workers that they need more. And those lower income workers, you're able to find that labor more often. Now, the risk here is that if you get a tick up in layoffs, you don't have that labor demand behind it to really offset a weakening jobs market or weakening demand for labor. There were about 1.6 million layoffs in June, and that was the layoff rate was only 1%. Now, if that just goes up to 1.3%, suddenly you have about 2 million more people unemployed over the next year. And that's a recessionary type of rise in the unemployment rate. And currently, 1 in 5 U.S. employers surveyed, according to the Conference Board, said that they plan to slow hiring in the second half of 2025. So what you're seeing is that the labor market is teetering. Now, it can teeter for a while. We can stay here for a while. Frankly, we've been here for six-ish months. And if you get the Fed easing and the yield curve steepening, and you get banks to kind of fill in the gap, if total earnings in the economy are declining, but that's countered by more bank lending, you could see the labor market hanging in there for a little bit longer. And that's why I say, I don't think we're at the end of this growth phase, but we're getting into the 8th or 9th inning. Now, I'm Justin Klein, and if today's show made you think about your own financial picture in any way, your investments, your taxes, your retirement planning, whatever that is, I encourage you to head over to InvestTalk.com, click on the portfolio review button, and we can set up a call and help bring clarity and confidence to whatever you are doing, whatever your goals are, wherever you sit today. And we thank you for listening, but we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes or Spotify, or watch our videos by heading over to our YouTube channel. Be sure to rate and review on iTunes as well. Independent thinking showed success. It's InvestTalk. Good night.